Hello, everybody. We are live. And I must say, I am very excited. This is the first ever OCTA I've done with a guest. It's normally just me talking about on-chain stuff. But now we have what I call the guru of on-chain. No offense, James, if you don't mind me calling you a guru. But I've been watching you and your stuff and your evolution since Glassnode. And now you have your own shop. Say hello to the audience. And thank you for taking the time. We are going to have a very interesting conversation coming up.
Absolutely. Thanks for having me on, mate. This is always good fun. And, whether I'm a guru or not, I'm an educated participant, but it's one of those things where in any skill in the world, if you put proof of work and you put hours in, you eventually get good at it. So that's the way I look at it. I've just put a lot of time into it. And the idea is that hopefully I've found some kind of, semblance of what I'm doing with all this on-chain stuff.
Yeah, and your background is quite interesting, and it's kind of inspiring as well, and it shows you that for the audience especially, that anybody can fall into any career path. It's not necessarily predestined by your education. You want to walk us through how you fell into on-chain?
Yeah, it's a strange world, and we're talking off camera like how sometimes life just throws you a ball and you've got to catch it. So I used to be a tunnel or a civil engineer, but a specific form of civil engineering, which is tunnel engineering, mining, basements, anything underground. And what's really interesting about underground engineering is you get whatever Mother Nature gives you. You don't get to put steel and concrete exactly where you want it. You might think that there's rock and you end up getting clay. And it's just one of those very expensive, hard to investigate, lots of probability, lots of risk. And you really have to have a good gut feel. Like, honestly, gut feel in mining engineering is really important because you actually don't know what's there. You can estimate it. You can have a reasonable idea, but you never know until you get there. So there's a lot of like understanding how the ground came to be. And in a way, markets are very similar. A lot of risk, a lot of uncertainty, a lot of incomplete information. And I found Bitcoin in 2018. I didn't understand it until 2019. On-chain data started to develop around late 2018, and I was downloading random PDFs on the internet and just like reading up on this weird, this very strange, like, oh, I can kind of visualize how this market works. So it was filling the gaps of like, I understood the market psychology component. That fascinated me first, how I just think price is human fear and greed against time. And then on-chain data filled in a lot of the blanks and was like, okay, now I can actually see the money moving around the system. And it just captivated me ever since.
That's fascinating. The engineering angle, the digging angle, the pipe angle. I've had some recent experience with pipes and digging and concrete, and it's kind of funny watching the guys literally very recently this year, and they were digging, and not only did they hit water pipes, but also gas pipes.
Oh,
And
yes.
electric lines. I mean, literally every pipe under the sun was down there. So
You'll be amazed how much stuff is underneath your feet. And, honestly, thanks it is, because you think about it, right? My stove turns on, the toilet works, the shower works, and you just wonder, like, where these pipes are everywhere, pipes and cables. The amount of engineering that goes on around us that you have no idea is just, it's astounding.
Yeah, well, we have a big agenda to get through. We're going to talk about kind of a whole bunch of on-chain stuff for Bitcoin, but also bigger macro stuff. We're going to look at kind of flows, institutional impact, ETF impact. In fact, yeah, that kind of rhymed. This is one of the little slides. Well, first of all, intro. We've done the intro, and again, Substack links are below, and all the ways you can follow James as well. But this is how we fell into this together, because I found your analysis very interesting, but also very different to mine on how the impact is for the ETFs, and your version of what I call a multiplier. So in my world, I'll take a step back before you can walk us through this, and then I'll walk through some of my models, and hopefully we can meet in the middle. But when Tesla did their $1.5 billion Bitcoin buy way back in 2021, I was able to kind of back into what that multiplier was for the price impact of one player buying $1.5 billion worth of Bitcoin over about 10 days. And it's purely coincidental that the multiplier I landed on was 21. Now, that's 21 times the 1.5 billion is the increase in market cap divided by the number of Bitcoin, which I have as 15 million, not 21 million, not 19.7 million, because I believe 5 million are lost one way or
It's
another.
about that many too. I did a very detailed study with Dave Peel. We came to very similar numbers, about 16 and a half or something like that.
And I've been tracking lost Bitcoin since 2017. I've got to share with you my spreadsheet later. But all the stories, all the anecdotes of all the lost Bitcoin, and in the community, people that send Bitcoin to the wrong address, and all, it's crazy what happens. And that poor guy in the UK throwing away his hard drive. I mean,
I hope he finds it, to be honest. I believe he's still digging.
Yeah, he's trying to actually buy what they in the UK they call it a tip.
Yes.
I don't know why it's called a tip, but
we call it the same here in Australia. Yeah.
Okay. They tip things into it. He's trying to actually buy it because he knows he's got nearly $1 billion in there. If he could buy it for 100 million and he just spends the next couple of years digging, it could pay off. But walk us through this. This is the first one of your check OnChain illustrations and where you believe we go. And then we'll dig into my multipliers and potential money flows for 2025 and down the line. But
yeah, so the rationale here, so just to kind of clear up, what do we mean when we say money multiplier? Because not every coin trades at the current spot price, right? That's how the market cap and price is derived. It's not really reasonable to say that you put $1 in and the market cap moves $1. You sell $1 and the market go. It's not how it works. There's usually some, and this is for all assets, there's some kind of multiplier effect, meaning that, if you put $1 billion in, you might get $3, $4, $5, $10 billion worth of difference. Now, I think another important thing is to understand timeframes, and this is so common in markets most of the time, and I would suggest this is where we're going to come to. The methodologies can differ, but almost always the number one thing that people disagree on is timeframes. So a lot of people say, like, when the market, let's say when we rallied from 73 to 100K, it's quite obvious. We went up, whatever that is, 50%. So we almost doubled. In fact, we would have doubled. We went from 50 to 100 from the lows. That does not mean that the market cap changed from 1 trillion to 2 trillion. $2 trillion did not come in that window. So what this chart is showing is a couple of different metrics. The orange is, and we're anchoring here to the COVID crash, or the first of 2020. How much has the market cap changed since then? And right now we're at 1.94 trillion, thereabouts. So that's kind of interesting because Bitcoin is about 1.9 trillion. So most of the market cap growth has actually occurred since the 1st of January 2020, right? All of the previous history, as log curves tend to do, disappears to be not much. So the question is, how much money had to come into Bitcoin to achieve that market cap change? During rallies, it's obviously not the amount that the market moves, but I'm of the opinion that the chopsolidation period we had through most of 2024, if you don't have 8 months of sideways, where lots and lots of capital got absorbed, lots of selling happened, and we saw loads of selling. Lots of selling happens, but that also means lots of buying is happening. That consolidation period before and the consolidation period we're in after, both of those two things are what you need in order for the market to go vertical for a month. So when I look at the multiplier, I don't look at it as like an instantaneous, what happened today? How much money came in today? And how much did the market cap change today? I generally look at things over a longer term time frame because my view is that markets are a process, not a result. So what we're looking at here in the orange, as I've said, that's the market cap change. That's the answer. So now we want to find out how much money went in to achieve that answer. Now, there's a few ways you can measure it. The green one looks at how much profit and loss, just adding them together. I don't subtract loss from profit. So how much money, how much did coins change cost basis is the way to think about it. Someone buys at 10K, sells at 100K, that 90K profit, that's what we're looking at. Someone buys at 50, sells at 10, 40,000 in loss. So we add those together over the whole history since 2020, and we've got 1.3 trillion. So the other way to think about that is somebody had to come in and allocate capital, new capital of about 1.3 trillion to achieve that 1.94. So that's what I would call the most conservative. That's basically saying that you need lots of capital to achieve that move. The realized cap down the bottom there in purple, that's 740 billion, which is quite a bit less, almost half the total profit and loss. But that realized cap subtracts losses because in theory, if you buy high and sell low, you've destroyed capital. If you buy low and sell high, someone's got to come in with more money to buy the same coin. So I think the purple line is more correct. So if we're looking at a multiplier, I would say it's probably something on the order of, let's just say 2 trillion divided by 740 billion. That would be over this time frame. That would be my gut feel. Now, the last one, you can see the edge.
It's It's about a
Yep.
3.5 or 4x.
Yeah, something like that. And I generally come to something in that ballpark between about 3 and 5. Sometimes it blasts to 8, but very, very briefly. So generally speaking, 3 to 5.
But you're looking at that R cap delta and prices made at the margin. That's how your multiplier is less than mine, which I hope the audience understands that. There's one thing that I found very interesting, and I haven't been able to prove it, but I had this theory. And let me walk you through it. Maybe you've got the on-chain answer. But I know as well from anecdotal evidence, from listening to people and trying to watch on-chain stuff, you saw right before the halving, after the ETFs launched, a lot of long-term holders were selling early. Now, I got a theory that a big chunk of those were selling their spot Bitcoin they've been holding for a long time and converting it into ETFs for security risk minimization. What do you take on that weird theory that I have?
No, I think there's a decent chance that a large portion of those coins. So if I think about it, there's a few different elements here. So the ETFs, and you could, when you look at the current environment, and this is the thing, Bitcoin, as it gets bigger, the capital also gets bigger, but it also must get bigger. So you need to have large institutions and $40 billion going into the ETFs to get us up to these higher altitudes. Retail can get us up to about $1 trillion. You need big money to go higher than that. So I do believe that there would have been a lot of OGs who were transferring their coins into ETFs. I also believe there's a lot of OGs who've gone, finally, I can offload 1,000 coins, 500 coins, 2,000 coins, and I can actually, there's a market big enough for me to sell to, whether it be the ETFs, whether it be the micro strategies, whether it be the institutions. This cycle is in fact different because I mean, at least from my perspective, it's quite clear that we have a more sophisticated and patient buyer. They are willing to sit there and just allow the market to come to them. We see a lot more dip buying in size. It's a lot less volatile. So all of these things to me point to a more sophisticated base. And I also think there's going to be some whales who would have sent their coins to an exchange and gone, hey, Mr. OTC desk, over the next 6 months, I want you to just distribute this slowly. So there will be like the one-time spend event, but then those coins are distributed slowly over time.
Yep, very good point. Okay, and then the final chunk is the ETFs, 40 billion.
Yes,
which we'll dig into, and I believe we could easily. It's funny because I shared this back in December. I believe we'll easily match 40 billion in 2025. What are your thoughts on that?
And from my framework, so the ETFs, where the multiplier thing came from, there's two sources. One, there's a bunch of people who are talking about this Bank of America 118x multiplier, and I was like, okay, just engineering wise, back of the envelope, that seems big. So I was like, let's try and prove it. So I was like, let's imagine there's not a single buyer. All the spot markets are gone. Binance doesn't exist. Coinbase doesn't exist. It's just the ETFs. They're the only source of demand. So when I first ran this study, I'm like, if the ETFs are the only source of demand, which we know is wrong, that accounted for a 32x multiplier. So even in the most ridiculous scenario, I could not achieve a 100x, let alone 118x. So the ETFs are obviously not the only buyer. Went from my studies, and it oscillates, but typically speaking, the ETFs represent about 20-25% of the demand curve. And this is the thing, a lot of people are like, oh, the ETFs are the only source of demand. It's like, what about all the spot markets that have existed for 16 years before the ETFs? They just disappeared? No, of course, they're still around.
Yeah, that's a great thing. Let me walk you through my thinking. So I landed on my 21 multiplier, which is calculated very differently to yours, but back in 2021. And then I assumed, back of the napkin, caveman math, the halving doubles the impact of the multiplier. But the market cap does get higher. So theoretically, it could have gone to 42. But again, it takes a lot more money to move the same realized cap for Bitcoin. But the point is, if we do get another 40 billion in 2025, just from the ETFs, not even talking about Saylor or anybody else, that could actually drive the price to $152,000 if that's assuming the current price of Bitcoin is 95K, which is automatic in the sheet, and that would be the delta. So we'll talk more about future price predictions, but they were kind of the multipliers I use, and they worked pretty well. Like my absolute bull target for ETF flows in 2024 was 50 billion. We hit 40 billion, which is pretty impressive. And then another view of this is basically, imagine you have Saylor doing 42 billion, like doing another 21 plus 21 plus Stark, etc. Plus, he's got now 3.3 billion potential shares to issue. If he does 42, ETFs do another 40, looking at the market cap delta, etc., that could bring the price up. Well, the multiplier 16.35 could bring the market cap delta up to add additional 2.1 trillion, or add additional 1.34 trillion, which would take the price to 175K. And this is how we get to 175K. So I'm just kind of pie in the sky. Imagine just two players, the ETFs and Saylor, no SBRs, no sovereigns, no miners hodling, etc. We'll talk more about the miners later. Do you believe this 175 is even possible?
So it just jumped back 2 slides to the one where you had your green cells. I think it was the first table, this one here. So correct me if I'm wrong. Are you saying here that the 40 billion goes into the ETFs? They would have a 20, let's say a 21 multiplier, which creates that 840, is that billion? So I think you're actually not far off. And the reason why is my multiplier, let's just say for argument's sake, it's 4 to 5. If the ETFs represent 20% of the market, that means you could, in theory, take that 40 billion and times it by 5, and that's the actual demand profile.
Yes.
Right? So if you divide your multiplier by 5, you actually end up at my multiplier, but I'm putting in all the money in your top cell, not just the ETFs. So more or less, that number is very much in the same ballpark that we're talking about, just looking at the ETFs, multiplying it by 5, and then applying your 4 or 5x multiplier. So similar ballpark.
Exactly. And then we'll talk more about this afterwards, because this takes us down the path of supply crunch. Is that even possible? I'm going to walk through a couple of very quick slides right now, just to talk about kind of the lay of the land before we start getting into the on-chain stuff. So far this year, this is from CoinShares, 5 weeks of solid flows. I've been tracking the ETFs daily since they first came out. 56,000 Bitcoin have been purchased by these puppies so far this year. And that does not include Saylor's bag either. Then you have a lot of, I don't know if it's rumors or fake news or whatever else, but CZ has been banging the table that Dubai has already some type of Bitcoin reserve. There was a lot of theories that Mr. 100, who actually is starting to aggressively buy again. I know people say, oh, it's an exchange. Yeah.
It's an exchange. So he just on Mr. 100, this is a crowd favorite. People love Mr. 100. Yeah. Here's the problem with whale watching, just full stop. So my general stance is I do not condone whale watching. I think it's a bad decision. And the reason why is, unless you're inside, and having worked at a data provider, I know how hard it is to track exchange wallets. They're very, very difficult. It's a constantly evolving problem. It's super dynamic. You need a team of very experienced data science. It's just a really hard thing. Most firms do not do a great job of it, right? Because it's so difficult. So the challenge is, if let's just take Mr. 100, which is in almost, I forget which exchange it is, but it's almost certainly an exchange. Yep. Yeah. So if Mr. 100 is buying 100 coins, what that actually means is somebody is depositing 100 coins. So your interpretation is perfectly incorrect, right? Buying is actually selling, and selling is actually withdrawals. So you kind of get your framework work backwards. And just the fact that people don't know which one it is means that your conclusions of all of these whales are just dead wrong. So generally speaking, I would encourage the vast majority of people, unless you are really deep in the weeds of on-chain data, and most people are not, I would not touch exchange balances, and I would not touch whale data. I think both of those are just full of errors, and not enough people actually understand what they're looking at. So they can be very misleading. Very good for engagement, not that great for real analysis.
Well, it's interesting. There's another wallet as well I call Mrs. 200, and I watch them, and
Mrs. 200.
Literally, I think 100 and 200 are somehow related, because their activity, I think they're kind of hiding the ball, playing with each other, trying to obfuscate exactly what they're doing, whoever they are. And you're dead right. But what's interesting is they seem to have gotten a lot better, a lot more sophisticated at DCAing. And that's not the typical exchange behavior. And I look at all the big exchange wallets, and many of them are stagnant for long periods of time, like 12 or 18 months. But anyway, moving on from that, the point is there is somebody stacking. We don't know who. And this came out a few days ago, yesterday, I think, from Franklin Templeton. And they see a whole bunch of nations building strategic Bitcoin reserves, first of all. And this is a big topic. Then you have what I call the SBR States of America. It's now up to 22. We are literally adding a new state every 2 days at this clip, which is bonkers. Now, the question I have for you is, we have never had this before: strategic Bitcoin reserves, nation states stacking, etc. And you and I both understand the scarcity aspect of Bitcoin. That's why we are here. It's fascinating. Have you thought about the impact of this in 2025? Not just treasuries. I'm talking about strategic Bitcoin reserves from nations or large states. You got places like Texas that are like the 7th largest country in the world if you look at their GDP. You got Florida just want to allocate 10 to 20% to Bitcoin as well. These are big, big players. Thoughts on this one?
Yeah, so I'm generally of the view, like, I think the SBR thing is interesting to see. And to me, the number one signal is that we are now talking about Bitcoin at the same level as gold. That to me is the big signal here. Whether the SBRs go forward or not, in my view, actually doesn't really matter, because at the end of the day, we are now talking about Bitcoin on the global stage, and this is crossing the event horizon. Bitcoin is now here. You may not like it, but it's here, and that's what's happening, right? So, and I find it really interesting whenever something happens over the weekend, there's some market event, even TradFi guys who hate Bitcoin, what are they going to post? They're going to post the Bitcoin price chart because it tells them what's going to happen on Monday morning. So Bitcoin has become this global asset. Now, are we going to see these SBRs? I don't know. I kind of view this from two different lenses. The scenario where we do get a full-scale SBR, complete and total embrace, blah, 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 all of that, great for Bitcoin's price, number go up, everyone's happy. So in a way, because that's a known outcome, to me, it's kind of less interesting. It's like, great, we all stacked as high as we could. That's how it goes.
Yeah.
My actual frame of reference is, what if these things don't eventuate? And that is where I think is the most interesting topic, because a lot of people want to see this happen. And I just look at the world, and I know a lot's changing in the US, but politicians be politicians, and you can't trust them as far as you can throw them. And these things are never as clean cut and simple as you would hope. So I certainly take a more measured view. It's like, if it happens, it happens. If it doesn't, that's what I find to be the more interesting scenario.
And I like that approach too. That's why I love to sandbag. I'm known as a hardcore sandbagger. So I know for a fact, even if you just take IBIT, BlackRock's ETF, and Saylor, they will buy more than the next 2 or 3 years of Bitcoin supply. And just that alone is staggering to think about. So let's pop up, let's talk about supply crunch, because a lot of people are interested in your take on exactly this. And I'll give you one kind of case in point: is MicroStrategy, since the Bitcoin halving, bought double the amount of Bitcoin mined. One player. I find that statistic staggering. And I'm not even talking about the ETFs. If you add the ETFs there, you're talking about the next 5 years of supply that will be mined is gobbled up by these two cohorts. And then you have other factors. I track OTC desks. I track, the lost coins we spoke about, etc. The amount on exchanges, which even if Bitcoin is on exchanges, it doesn't mean it's for sale. It means people don't trust their own self-custody. And now the OTC desk are down to 118,000 Bitcoin. They were 430,000 Bitcoin 7 or 8 months ago. That's a big drop, as well as the precipitous drop in the amount of exchanges. And I know you said it's very hard to read that and analyze that, but getting back to big picture, Jeff Booth, who's been on the channel a few times, a very based guru like yourself, believes supply crunch is incoming. All the data I look at, it tells me it's imminent. And I'm sandbagging. Am I crazy?
Yeah. So the way I think about this whole concept of a supply crunch is very exciting. I've never seen OTC data that is accurate ever. So I put OTC in the same bucket as exchanges. So I think you had there 2.4 million on exchanges. There's more like 3.5 million. So we're missing about 1.5 million from whatever that stat is, wherever that's from. I know for a fact that, so I know for a fact that Coinbase custody has an additional 1 point something million Bitcoin. So this is the problem with this data. Every single data provider has a different set of heuristics. They don't talk to each other. They're never consistent. The problem with the supply squeeze and supply crunch, there's two things I want to touch on. The first one, it is a useful heuristic to measure things against newly issued coins, right? They've required 2 times the new coins. That's important. However, new coins and miners are an insignificant chunk of the market. Insignificant. So I've got a couple of charts on my website that I use, and I do it humorously, but the idea is I've plotted issuance. There's issuance shown on a handful of my charts, whether it's trade volume or capital flows or whatever. And every so often I'll grab my charts and I'll zoom in and I'll zoom in and I'll zoom in and I'll keep going. And I'll say, can you see it yet? No, keep going. You've got to zoom in so far to see this minuscule little thing down the bottom that is issuance. So measuring things against issuance, in my view, is useful on a relative benchmark. But for example, existing holders, people who've held their coins for 6 months or more, they're selling 20,000 Bitcoin a day as it stands right now. So the miners are just irrelevant by comparison to existing holders taking profit. So the problem with the supply crunch narrative is that often it's measured against issuance, and that's, I think, too small and kind of too irrelevant. And the other one is that it doesn't account for the biggest sell pressure that there is, which is OGs and people who have just been around for a while. And when I think about where people are in their hodler's journey, the average holding time, like the average person, at least based on my statistics and my audience, basically it's kind of clustered around that 2019, 2020 era. There's most people who came into the 2020, 21 cycle. There's another like 40% of people who from the previous cycle, which is where I came in. If you kind of think about the average age and holding time there's going to be people who, if we go to 200,000, for example, they're going to be selling some to buy a house. And the higher up it goes, the more the market's going to have to finance the lifestyle of Bitcoiners. That's where the sell side comes from. And that's actually not from my issuance.
Yeah, that's so true, because everybody has a price that they will sell. And that's
the higher it goes, the more people will sell. So this idea of a supply squeeze, it happens, but then it goes away because people sell into that rally, which is always what's going to happen.
Exactly. But there is another theory that I've been trying to get at too, in a crude way. I've looked at all the historical cycles and I calculated the amount on average that a long-term holder cohort will actually sell during a bull market. And that typically reaches somewhere between 30 and 40% of their bags maximum. We are 71, 72% into that 40% of sell pressure. So my question is, imagine you take long-term holders, they have 70% of the supply. They are 70% done selling that supply, the amount of what they will sell, which is about 40% of that 70% of supply. So there's not much left for them to go. You know, they're clever. You saw a huge sell pressure happening once you broke 100K, a little bit before 100K. And you saw all those people, again, taking profits, buying that. Yeah, I remember reading about you writing about the $1 million tiny apartment in Sydney or something. It doesn't even, 10 Bitcoin.
$1 million barely gets you a single bedroom apartment in some backwater part of Sydney at the moment.
Oh, it's not even downtown, huh? Crazy. But
yeah. So the way to think about this, so I always think about things in terms of, I try to hold two views at the same time. And I think this helps kind of, as an analyst, helps you just ground things. So we've seen two major sell side events from long-term holders, as you mentioned. The first one, so generally speaking, long-term holders start selling as the market reaches the previous cycle all-time high. And we saw this like clockwork this time as well. So when we got to 73K in March last year, the amount of sell side from long-term holders was about $55 billion a month. So pretty sizable, and by far and away the biggest that we've ever seen. That persisted for several months, and we chopped around for a while. The market digested it, and then we saw the second wave of selling as we rallied up to 100K. And in that instance, they sold something about 85 billion. So again, two very, very significant sell side chunks, by far and away all-time highs. It is now starting to dissipate. And I call this the lead foot of long-term holders, because if you think about the market as having an accelerator, a demand accelerator, and a sell side break, then if you depress both of those pedals, right, you've got the demand coming in, because every sold Bitcoin is also demand. So that 85 billion a month of sell side is being absorbed by somebody, because we're still up here at 95K. So you've got the accelerator on full, you've got the lead foot on the brakes. So now think about what happens if the lead foot starts to come off and your accelerator remains depressed. Suddenly the car starts moving forward. On the flip side, if you start taking off the accelerator, which at the moment we're actually taking our foot off both. So you that's why we're going sideways. You're taking foot off the gas, but you're also taking your foot off the brake. So the car stays stationary yet again. That's kind of the environment that we're in, but it does allude to what you're talking about with this long-term sell side.
Yeah, that's really, really appreciate this insight. So let's get into a little bit more stuff here. First of all, the institutions, not just the ETFs, but the institutions. There's a lot of people following the MicroStrategy Saylor playbook. Many of them are companies that are desperate just to pump their stock price and things like that, and hitting the dilution button like crazy. But there's so much of it happening all at the same time. What is your take on the Bitcoin strategy playbook?
Yeah, it's a very good question. So first things first, what Saylor is doing is breathtaking. It's amazing to watch. I've certainly learned a lot about how the finance world works just by seeing him engineer all of these products. What's interesting, and I wrote a piece about MicroStrategy because it was one of those things I hadn't done the mental loops for. What I came to is, I think it's not an overly special result, but it's going to do very well in the bull, I would say, but it's going to be very difficult in the bear. And I think we're actually seeing this at the moment. A lot of people kind of bought into the hype, and it went from, a very small market cap to over 100 billion, and it's now chopping around. There's a lot of people who have cost basis that's much higher than where we are. There's a lot of people who bought call options expecting it to go to $1,000, and it has expired worthless because it's at 330. So there's a lot of these dynamics, but what MicroStrategy does is they sell volatility, and more importantly, they sell volatility on top of Bitcoin. Now, they need to continue to generate that volatility. Where does that come from? At the markets, convertible debt, all sorts of things where Saylor has to basically generate, for want of a better term, volatility, hype, and premium around his stock. Are there other companies who can pull this off? I don't know. When I start seeing miners, like, do they have the stones that Michael Saylor does in the bear market? I don't know. When I see miners doing this strategy, I look at it and I go, well, the thing with MicroStrategy is that their operational business is not a large overhead, kind of as a self-sustaining entity. Miners are guaranteed to go bankrupt over a long enough time frame because mining is just a brutally capitalist industry. Are they in the right place to be doing this? And it's funny because if I go back to 2021, I was of the view that maybe now we've got public companies, they'll be a bit more sane and they won't go bankrupt. Wasn't I wrong there? Because, of course, miners have always been pro-cyclical. They hodl on the way up, they hodl all the way on the way down, and they sell at the bottom. So they essentially add to the buy pressure on the way up, and they add to the sell pressure on the way down. I can't help but feel we're going to see this again and again. I saw Saylor met with, I don't know if it's the CEO of GameStop.
Or GameStop.
GameStop. And what I've said many, many months ago, when you see GameStop putting Bitcoin on their balance sheet, we are getting very close to the euphoric peak. So just keep that in mind. That's not a great sign, in my opinion, because I don't know if they can weather this, the drawdown.
Well, it's incredible because on the last GameStop pump, they issued a truckload of shares, $100.
It was like $3 billion or something, wasn't it?
Yeah, now they're sitting on about 1.3 billion in cash. Literally, and the stock is back to $10, which is where it belongs or lower. So it's a classic, interesting case in point as to what happens here next. The real question, though, is, I believe there can only ever be one MicroStrategy because they have the first mover advantage. It's impossible now to build a bag. I estimate they'll have 500,000 Bitcoin within 3 weeks, and they were ATMing today. I could see it on the chart, but it's basically selling stock, no buyers. Price tanks down to 320, and they're going to continue to do that. Another theory I have is great because you're giving me a very different perspective on the kind of the thoughts that I see when I look at the market. I go back to Saylor's smile. He rarely smiles, but he's been smiling since the middle of December, which means, billionaires have a grapevine. They're up to something. They know what's going on. They know what's coming. And he is buying as hard as he can, price be damned. What's your take on that? Does he know something really big is coming?
That's a very good question. So when I think about, and I wrote about this, when I think about the long term of MicroStrategy, and every single person watching this stream, if you are stacking Bitcoin, we all have this problem. Every single one of us will eventually hit our bit life crisis. And that is because there's only 21 million, it's a logarithmic curve. Doesn't matter how hard you stack, your supply curve will always peter out. So if we think about what MicroStrategy is running at the moment, it's a growth playbook. Bitcoin per share, Bitcoin yield, blah, blah, blah. By definition, over any time frame, that will eventually go to zero. So suddenly those growth metrics will go to zero. So my general view for MicroStrategy is the gravity, where if Michael Saylor stops doing anything, just walks away and just lets the company do its thing, the gravity is always to go back to the ETF value of his holdings. So he has to continue to fight to keep the stock at a premium to that NAV. And ironically enough, what does Michael Saylor do? He sells MicroStrategy shares to buy Bitcoin. If you think about what that is, there's an infinite amount of MSTR and there's a fixed amount of Bitcoin. So but the long-term result, no matter which way you cut it, is to go back to ETF value. So there's the challenge. And that's what people are speculating on. What should that premium be? Is 3 too high? Is 1.5 too high? Is it too low? The market doesn't know, but that is the premium that people are speculating on. And that's why he continues to announce certain things like, oh, we've just raised this money, or we're doing this new thing, because it keeps the market going, whoa, what's he going to do next? It's that premium. That's what he's trying to do, create that volatility premium over time.
Yeah, I've been calling it financial jiu-jitsu since day one.
Yeah. I call it the Saylor premium. It's just all that stuff. Is he going to be a bank? Is he going to be now he's strategy. Is he going to be a bank eventually? Like, what's he do with all this Bitcoin? But I agree with the first mover advantage. I think there's probably one other thing there. The first mover advantage is definitely a thing for that company. However, much like if you envision a gold bull market, when gold starts running, the biggest miners with the best cost of capital and the best all-in sustaining costs, they will eventually move first. And then later down the line, the more speculative companies move, because when the gold price breaks above their break even, their multiples go up significantly more. They're still shitcoin companies, but their multiples increase much faster once they're back in the green. That's kind of what I think is going to happen here as well. There'll be a bunch of these smaller companies who are going from 0 Bitcoin to some Bitcoin, and that's an infinite percent change. And then they add another lump, and that's 100% change, right? So they will also eventually hit their BitLife crisis, and everything will slow down.
Yeah. Again, there's another weird theory, and this is like a 5 or 10% chance theory that ties into, okay, what happens? And I remember at Wharton, I studied game theory, and literally it melted my brain. It was like 25 years ago, and I started thinking about game theory and how it works, etc., and prisoner's dilemma and all that good stuff. But now, for the first time, we have a real use case of a very finite asset. And what happens if all those dominoes fall? What happens if sellers dry up? What happens if the long-term holders are done selling their portion, because they will always keep 60 to 70% of their bag. They're only going to sell 30 to 40% of their bag, which I think you agree on as well. Mm-hmm. Then supply dries up, or the ease of accessing supply dries up. You get instead of a kimchi premium, you get a global kimchi premium. And then again, there's a bit of mental gymnastics here. What's your only on-ramp? It's quick and easy to get, and that becomes MicroStrategy. Like the Central Bank of Norway owns 1% of MicroStrategy. You could argue, yes, central banks are now stacking Bitcoin. But what happens if that tipping point does come about and the dominoes really begin to fall?
And I think this is what a lot of people bank on, right? Is that multiple could expand to 3x, 4x, 5x, 10x. Yeah. And I think this is going back to the multiplier conversation we had before. This is why it's really important to understand timeframes. These are what you would call an illiquidity moment. And there'll be bulls out there on Twitter saying, look, the supply squeeze is here. It's the mother of all supply squeezes. And I use this this framework to help people think about, because the way I like to frame things, I want people thinking 6 months ahead of what could happen. It doesn't matter if it does happen. Just go through the mental loops of what if it does. And what more importantly, what will you do if that happens? So the way I frame it, that what you're describing there, imagine you wake up tomorrow and Bitcoin's at 800,000 or $1 million a coin. What are you going to do, right? Have that mental loop in your mind, because in that instance, my saying is that the bull market will author the bear that follows. I can't see an 80% correction from 100K. I just don't think we're going back to $20,000. I think that's highly improbable.
Yep.
If we go to $1 million, now I can see an 80% without too much difficulty. Yes, we come back down to 100 or 200K. Now I can see that happening. So the way to think about that is that we may get that global liquidity squeeze. However, it's going to be a fleeting event. It is unlikely to be this kind of long-term repricing. The bear market and the chop that will follow that will be tremendous and an opportunity, but it will be a tremendous drawdown.
Every sentence you say spikes another question in my little mind. Bottom. So historically, when you look at U.S. presidential elections, which are confluent with Bitcoin cycles, and of course, the impact of the halving cycle is becoming less and less every halving. That's just simple mathematics. But history tells us that the bottom is 70K. Do you believe in that theory?
So the way I look at this, historically, Bitcoin has bottomed around. There's a model called the realized price,
Yep.
which is the average cost basis per Bitcoin. Now, there was a study that Dave Puel and I did 2 years ago, 2022, I think we released it, called Coin Time Economics. And that, I won't go through the details because it was a 120, it was basically a book. And by far one of the strangest rabbit holes I've ever been down. But one of the big outcomes of that study was we found a model that we developed from first principles. The problem with the realized price is it contains all of Satoshi's coins. So
Yes.
think about this. To be at break even, Satoshi's got like $15 billion of unrealized profit. This is back when FTX blew up. He's got $15 billion of profit that he can't spend and take, lost miners, all that. And then you look at, that means that there's $15 billion of losses of people who actively participated in the cycle to reach that break even level. So the framework was, we are counting all these coins that cannot provide, they're not active in the market. So we tried to develop a pricing model that is better at telling us where the active investor is. Then we ran some statistics and we found, oh my God, this thing is literally smack in the middle. Long-term mean and median of 1, meaning price literally oscillates around it. And I had this thesis back in 2022 that what if we don't go back to the realized price? Because it's too low. It's actually overestimating the downside because of those dynamics. Now, we then had Luna, Three Arrows Capital, and FTX. Mass fraud, mass explosions, like just all this really nasty stuff. A GFC had to happen to get us down to the realized price. So we did get down there. So I was wrong on that. However, my thesis remains, I've been thinking about it ever since. I don't necessarily think that we have to go back to the realized price in future cycles, future bear cycles. I think that true market mean model is probably going to step in and perform the role. Now, that is currently trading from memory about 65, 66K, somewhere in that region, back in our 2024 range. That is where the average investor, not the average Bitcoin, the average investor, that's where their cost basis is. And I have a feeling if we were to draw down to there now, it's like a 45% correction. Let's just imagine the top is already in. I can absolutely see a bear market coming down 40, 45%, going back into that chop consolidation range, bottoming at like 60K, and then away we go again. I can see that happening. And then people would be like, was that a cycle? Was that a bear? Did we start again? Like, people are going to lose track of where we are in this cycle. And I think that's my base case moving forward, is that not that we go back down to 64, but that people will lose track of where the hell we are. That's my base case for this cycle.
And it's staggering because I see that a lot, because humans, no offense to ourselves as humans, but sometimes memories of goldfish comes to mind.
Biases creep in.
Although this time it is a little bit different, because I still see a huge amount of PTSD from the last cycle. Huge amount everywhere I go.
And I believe a lot of this is this divergence between Bitcoin and crypto, because that is a very real phenomena that most people expected: the Bitcoin, Ethereum, Solana, and then all the way down to the long tail. And we got Bitcoin, Solana, shitcoins. So we just didn't get the capital rotation that people expected. And then alts got murdered recently. So we've just got this really interesting dynamic where Bitcoin is just separating out, and there's a divergence in sentiment. Bitcoin's at 95K, and sentiment is about as bearish as I've ever seen it. It's incredible.
It's like people are like asking questions like, when's the bull market going to start? You know, they forget we came from 15.5.
It's happened.
It's like,
it's over.
It's crazy. So let's talk about what I call the new whale world. Again, from Crypto Quant. If you had a chart like this, I'd share it, but maybe you do somewhere and I missed it. But this is the old whales versus new whales. These are the 1,000+ Bitcoin bag holders. And we've never seen a historic spike like this. And it ties back into Bitcoin realized cap, which you are very familiar with. What is your take on this? Is this just all Saylor and IBIT, or others?
It's a very good question. So I can't say, because I don't know once again, when it comes to whale data, I don't know what Crypto Quant has done to achieve this data. So I can't really say. It's one of those things where the thing with whales, shrimp and crabs and all small entities, we all behave the same way. So you can actually take this like aggregate view of what are the shrimp and the crabs doing, right? People with less than 10 Bitcoin, we all kind of do the same thing. We DCA in the same way. We consolidate our wallets in the same way. You know, there's a few different patterns, but we all kind of do the same thing. So you can look at it as a giant mass of people doing the same stuff. Whales, whole different ballgame, because we're talking about like 200, 300 entities. Are they an exchange? Are they not an exchange? Are they an ETF? Are they a custodian? Are they an institution? I don't know. What if some of them in here, what if some of the orange and the older ETFs and exchanges, and what if some of the purple is some of the newer ETFs, and maybe it's Saylor, or maybe it's, I don't know, is it Coinbase custody? Is that accounting for the million coins that CryptoQuant doesn't have in their exchange balances? This is why I just, generally speaking, say folks should be very careful when they use this data, because unless you know the answers to those questions, which I certainly don't, I think it's very hard to draw any reasonable conclusions. That's not to say that CryptoQuant isn't doing their numbers. They probably are, but I just don't know how to measure any of this stuff because I've never seen a data provider do it with crystal clarity on what's going on behind the scenes.
All right, let's talk about another. This is like the 17th elephant in the room so far. And these are things that I think about all the time. I've been looking at on-chain data since it began. I am fascinated by it because it's the only market on the planet where you can see everything transparently. But you still have to deduce a lot of conclusions from the data you're looking at. But how much, and I think the answer is a lot, does the impact of ETFs and Saylor stacking impact traditional on-chain metrics and data? How is it shaking up your world?
Fantastic question. One that I have a long overdue post that I will be doing on this topic because I get it all the time. And that's one I'll probably just do outside the paywall, so that when people have this question, it's like, here you go. So the rationale is I don't think it changes it at all. And it's probably not the answer you expected. ETFs are not new. They're not new, right? What are ETFs? ETFs are a pool of coins where they go in and then they trade around inside off book. Where have we seen this before? Exchanges,
manipulation,
GBTC, MicroStrategy, ETFs. They're all the same thing. They are a pool of coins where they trade around off book. Now, the beauty of on-chain data is what we're not looking for perfect answers. And this is what I think a lot of people get wrong. You actually aren't trying to measure the perfect number in any of this stuff. If coins go into the ETFs and then those ETFs, by and large, they just sit there as UTXOs, right? There's a couple of inflows in and out, but it's like 1-2% of the balance less than on any one day. Most of those UTXOs do nothing, which means that when we're looking at metrics telling us about people's spending behavior, they don't even show up. It doesn't matter. So the way to think about all data, not just on-chain data, when I look at futures funding rate, what I'm doing is I'm taking the futures market and I'm surveying their population and saying, are you bullish or bearish? And then I look at the on-chain world and I look at MVRV and SOPR and I go, are you bullish or bearish? And then I look at the ETFs, inflows or outflows, bullish or bearish. What happens if they all tell me that they're bearish or they all tell me that they're bullish? What I'm doing is I'm surveying a subset of the population, which in this case is the entire UTXO set, every ETF investor, every futures trader, and I do a survey. And then I extrapolate and I say, if people on chain are bullish or taking heavy profit, what's going on in the future? Oh, look, on chain guys are taking lots of profit. And some dude on futures markets is going levered long and paying 50% interest rates to do so. Looks like a local top to me. That's how I frame these things up. So actually it doesn't impact it because we're not trying to door knock everyone, just a statistically significant subset.
Okay, I got to interject a comment here from the audience live. Yes. I hope that's okay. A lot of people are interpreting what you are saying is that the bull market is over.
Yeah, for altcoins, I think they're in serious trouble. Yeah.
Oh, altcoins, yes, but we're talking Bitcoin here. This is purely
Bitcoin is going to be just fine. And good. This is what this is what I think is a really interesting, and this is why sentiment's so busted in my view. Now, again, I am the first to admit, and I say this all the time, I have no idea what the future holds. Nobody does. Anyone that tells you they know what's coming is lying because no one does. No one can pretend. We can make probability estimates, but when I look at what's gone on this cycle, it's been very interesting because in my view, the veil has been pulled from a lot of crypto because meme coins is really the admission that there's just not much there. And we kind of went, I mean, fart coin has been one of the best tokens, right? And that's fine, right? People want to speculate and gamble. That's perfectly fine. But when you look at that happening, you kind of look at the rest of the crypto ecosystem and you go, there's been hundreds of billions of dollars spent here. And what do we have to show for it? Stable coins? There's just not a lot there. And I think Bitcoin is clearly separating itself. So I think Bitcoin has actually broken free of whatever this crypto cycle is. And now crypto coins are trying to work out where do we fit in all of this? So I think it's important to kind of at least recognize that there has been a separation. Where go Bitcoin, not so go crypto now. Crypto now has to find its own footing. And that's why I think it's important to just separate those two. Bitcoin's going to be just fine. The fact we're at 95K and people are bearish, that's the signal.
I'm glad you said that, because I always say 1,000 times, 99.5% of all crypto are complete garbage. And the fact that things like Bitcoin dominance are even compared to a huge bag of garbage doesn't make any sense. It's like truly apples and oranges. They need to be in their own distinct classes. But there is one point that does kind of give me a little bit of concern. And again, let's talk about this one. With all the ETF action and the stacking, I know you said ETFs are nothing new per se, but you know, the mempool transaction count by fee cohort, basically on-chain activity is dying. I've got a couple of questions for you. We know the runes and the ordinals and everything spiked a lot of activity. That's the big purple stuff you see there.
Yep.
But all of a sudden, it's gone off the face of a cliff.
Which ironically aligns with the crypto nuking this week.
Yeah, exactly. So meme coins and ETF for NFTs and all that stuff is probably dying a slow death. But two questions. One, this sometimes historically happens mid-cycle for Bitcoin. It's like a quiet period on chain, but maybe I'm wrong. Let me know. Second of all, is this impacted by so much stacking by these ETFs and Michael Saylor, MicroStrategy, etc.? Like basically pulling coins off chain, making them inactive.
Yeah, so I don't think that's what's going on, because as I said before, we had Binance and Coinbase before. They were just the old ETFs where coins go in and they trade around. When we look at spot volumes, but I haven't checked this in a couple of days, but last time I checked, everything was cooling off. And I wrote a piece that was called, I think it was called like Steady But Slowing Down.
Yeah.
And it was when this started to happen. We've seen transaction volume coming down, counts coming down, fees coming down. Strictly speaking, if fewer people are using Bitcoin, that's not a good sign. You actually want lots of people using it. So just strictly speaking, that is a sign that you should go, okay, we actually don't have that much activity. We do need to factor in that a lot of the activity that was there was runes and all that kind of stuff. All of this is telling us that we've got a real slowdown, right? So first and foremost, like we're probably not going to 200K tomorrow, just based on it's a soft signal, but it's a signal. That doesn't mean that Bitcoin is going to die. But what it does tell us is that, like, you know, it's slower. Now, trade volume is still relatively high. I have to go back and have a look at it, but it was cooling down, but it was still like 2021 bull market peak levels. But that's because Bitcoin's trading much higher, right? It's a $2 trillion asset now. So I think it's important to just keep in mind that markets are a process, not a result. And there is no answer. There's no end game. Even if we would correct lower, that doesn't mean that. In fact, I did a study and I showed that if we got down to like 75K, it would still be in bull market conditions quite comfortably. The damage that would be done if we sold down to 75 actually isn't bad enough to break the spirit of the bulls, in my view. We'll see how it plays out, but like I actually think that that's probably going to be a defended level if we ever got down to that point. And the bull market continues, right? So that's my base case, is that we're in a structural bull. It's going to take time and process to get there.
Yeah, and I go back to the 70K level because that was the price on the eve of the US presidential election. And that historically has been the floor, but you're give or take 5K down to 65K, 70K, 75K. It's a nothing burger. It wouldn't destroy morale because people that have been in Bitcoin for a long time have had far worse drawdowns, as you are well aware. Let's get into, because this is about on-chain, I want to talk about your favorite indicators, my friend.
Yes.
What do you love? And I know there's so many, but I'd love you to help frame up for us kind of your favorite on-chain indicators, and then we'll talk about how they can be used to identify when we're getting close to a top. Because in full disclosure, we have created a composite score of about 21 different on-chain indicators that are fed live to tell us when we're getting hot. And there's many different flavors of this, but this one has been kind of back tested. And I was actually relieved to hear from you that the ETFs don't impact on-chain. That's my
out of interest, if I was just to spitball, is your composite index, if we're going in sports terms, we're hitting off on the fourth quarter? Is that kind of the ballpark that this thing would be sitting?
Yeah, we're at the not the third to top level. So we're at the orange level now. Then we go dark orange, and then we go
Caution,
red.
orange. Yep.
Red,
Yeah.
red
So
is
we're
like
in that like,
right,
we're in that like 70% zone.
And I warn people, and people get very depressed, and I say, hey guys, we're like 70-80% through this run. And then they call me Debbie Downer and a mega bear and all that type of stuff. But these are just facts of life. So tell me, first of all, what are your favorite on-chain indicators? How do you use them? I've got a couple that we can pop up here too, just ones I pulled recently. One is hash rate. And the concern maybe for miners, and we'll talk about some of the short-term holder cost basis, which I find very interesting, as well as the realized cost and stuff like that. But tell us how you identify when we're getting close and what your favorite on-chain indicators are.
So for most people, and by most people, 99% of people, there's only two metrics you actually need to get your head around. Technically, it's three, but MVRV and SOPA, right? And I'll talk about what these are. You saw in that chart before, you've got the short-term holder cost basis. We've got the realized price. We've got the true market mean. What are these levels? These levels are essentially where we expect the market to mean revert to. They are the average cost basis of investors who bought recently, short-term holders. True market mean, the average cost basis per active investor. These are levels that we expect Bitcoin to come back to, whether on the short term with the short-term holders or on the long term with the true market mean and the realized price. So MVRVs are just ratios between price and the cost basis. So think about this. If your cost basis is $100 and the price is trading at $200, your MVRV is going to be 2 because its spot price is 2 divided by 1. MVRV is 2. MVRV tells you your unrealized profit or loss on average. Now, what drives people to make decisions? And when I say decisions, to sell, right? In this case, in a bull market, what drives decisions? It's to sell. In a bear market, it's to capitulate, right? So what does a high MVRV value tell you? That lots of people out there are very profitable. What happens when lots of people are very profitable? They take profits, right? That's the sell side. That's what creates tops. That's the thing that actually kills the bull. So when the MVRV ratio gets very, very high, it tells you that lots of people are very likely to sell. The sister metric is called SOPR, S-O-P-R. It tells you the average profit being locked in. So you can look at MVRV and say it's very high. And then you go, are they taking those profits? You look at SOPR. Oh, it's also very high. I have the incentive and I have the result. That's what tops look like. And I think another thing that's important, a lot of people, if we got to 120 to 150, that zone, that's my like topping cloud. That doesn't mean the top. It might be, but you've got to remember the top is relevant to you. Which top do you care about? Because if you're a leveraged futures trader, the top that you care about is the one that just liquidated your account, right? That's the one that you actually care about on the 1 minute time frame. If you're a hodler, the next top might be $1 million. That's the one that you care about. If you're a retiree, the top that matters to you is the one that's going to give you 3 years of runway to live your life. So know what top matters to you, because if we get to 150K, it may be the top. It could just be a top. We don't know, but it's probably not going to bust through first time because all those metrics are going to hit very high levels around that zone. So, as an analyst, as an objective analyst, it is improbable. And when I say improbable, less than 5% of the time has MVRV gone above that level. And it's important to remember in that last, you said we're 70 or 80% into the bull. The last 20% is the most insane bit, guys. That's the bit that's the most vertical and the most exciting. But the more vertical and exciting it gets, the less likely it stays there. And that's the important thing to recognize. It can keep going, but the probability of it staying up there is much, much lower.
So AKA blow off top, and I call it mean reversion because everything mean reverts. Exactly. And the faster it goes up, the faster it comes down. That's just gravity.
And the higher it goes up, the deeper it comes down. The bull market will author the bear that follows.
Exactly. That's probably the most important thing that's been mentioned twice in this video for the audience to really recognize. So we have those two indicators. Tell us your take on one of the things that I've thought about for a long time since 2017, and I have never sold Bitcoin because I'm in a position to hedge it. I don't need to sell. I can protect my downside without incurring capital gains. And it's a very difficult thing to sell. You become emotionally attached to Bitcoin. But my number, again, studying what the long-term holders and the whales do, they never sell all their Bitcoin. As people probably here in the audience, they're planning to get out at whatever number is their target. But tell us your approach. I believe in layers. I believe in hedging. I believe in looking at TA indicators to determine when things are really overheated, as well as on-chain indicators too. How do you approach, say we all of a sudden, there's big news around the world about some sovereign nation, and that triggers panic everywhere, in pension funds, in treasuries, you name it. And then we get that kind of weird, crazy spike. How do you approach it mentally?
Yes.
And what would you
say?
say?
I write all my newsletters from two perspectives. There's check the analyst, and his job is to be very objective and like just analyze the market and say, this is where I think we are, this is how I think it's going. And then there's check the hodler, which is, I'm long corn. I love Bitcoin. I want to buy it forever. I think it's a great asset. And that's trying to like capture most people, right? It's like, here's all the information, but what do I actually do with that information? And probably the best thing I can give people as a piece of advice, make your decisions ahead of time. I have a decision framework already in play. If we go down to 80K, if we go to 150K, that decision may be to sell, it may be to buy, it may be to do nothing. So for me, my price is higher than 150K. So even though I'm quite sure that we're probably not going to get through 150K in one go, you've got to get through 150 before you get to my price. So it's part of the process. So for me, what does check the hodler do with that information? If check the analyst goes, we're at 150K and there's like a 4% chance we're going to keep going higher, check the hodler might be like, well, 150 isn't my price. I'm just not going to buy right now. I'm going to wait for the steam to come out of this market, and I will wait and I will buy later. If it keeps going, so be it. I've made that decision. This is my plan. But that's the way that I like to think about it. Have your decision beforehand. Because if you go back, and I would say everyone who's watching this has been through this, what are the things that are the most painful in markets? It's usually when you put a big chunk of money in and the next 2 seconds is just the giant red candle and you feel awful. So I just want to avoid that. I want to be the one who buys the bottom of that red candle as best as I can. I just don't want to be the one who buys the top of it. So in a way, think about what your pain point is. For me, I prefer to generate income. I just like to stack Bitcoin. One day the Bitcoin will pay for my long-term time expenses. But at the moment, I can just generate income, live my life. And for me, I don't want to sell my Bitcoin. I want to hang on to it, but I also don't want to buy it too high. And that's how I think about it personally.
Yeah, fantastic insight. And I always try, a very wise investor told me in the early 90s that it's very, very important to understand how the brain works. And I think a lot about that and have done extensive psychology research. And I'm not a psychologist, but psychology when it comes to markets is absolutely fascinating. And I discovered something last year from a massive survey we did with over 10,000 people completed it. And people basically they're more afraid of not winning than they
Yes.
are of losing.
Yes, very
You know,
real.
this is crazy. And so I'll spell that out with an example. Imagine Bitcoin, you buy at 100, it falls to 50,000. You're okay with that. You can handle it. But if you buy it at 100 and it goes to 150 and you sell at 150 and then it goes to 200, people are very depressed.
That's more painful. Missing the train is psychologically more painful than taking an L.
So what's your perspective on why that is?
Oh, that's very, very real. And this is actually why on-chain data is so powerful, because it's rooted in human psychology. You can see when people sell the top, smart money. You can see when those people who bought high capitulate low in micro, like little chopping around. People sell the bottom all the time. And I got into this market. I bought the 2017 top. That was my entry into this market, the absolute Pico top. And I go back and look at SOPA, the metric I mentioned before, and I can see myself buying when the smart money was selling the most amount of coins at the highest profit. And I can see the moments when I sold going, it's going lower. It's at 6K, it's going lower. And I sell it all like every other idiot. And I take the L and then it bounces back to 10. And then I buy a 10 because it's very exciting.
But let me say, I bet you that was life-changing for you, because that made you, like me, as I've got to understand how this stuff works.
You
And then you
must
fell
pay
down the
your
rabbit
tuition.
hole.
You must pay your tuition, lose some money. You have to lose money in markets. But the thing you were describing before, the reason why people lose so much money, particularly in the world of crypto, is because they keep chasing the next pump because they're afraid they're going to miss the next 1,000 bagger. And this is the amount of people I see on Twitter who are like, I can't buy Bitcoin. It's not going to go up enough. It's like, well, if you just consistently save in Bitcoin, it actually does tremendously well because it doesn't go to zero, right? So the idea is that over a long arc of time, if you just continue to stay humble and stack sats, Bitcoin does tremendously well. And you don't have to worry about these 1,000 baggers because you end up actually losing more money than you do getting a winner, right? Very few people actually win.
Well, I always say one of my investing rules is don't chase, replace. So the people that chase these pumps will end up being bag holders as everything kind of mean reverts. We're getting close to the end. We're probably going to have to do this again because I got a lot more questions, and every single answer you give me opens up a new can of ideas. But, you had some, let's just look at the world out. I believe we are in a very fast changing world. If you look out to 2040, could Bitcoin even exist? I wouldn't be surprised if it didn't, to be honest, unless it has a radical technological overhaul, as well as more value added built into it, or it becomes like gold. We'll see. I do believe also that volatility over time will go down as it becomes a much bigger asset. But, from where we are, you lived through 2017, you're late to join the party. That's when I first dabbled in actual Bitcoin as well. I took a part of my savings and put them in, but very small. And then after the fall, I was like, wow, I'm glad I put a very small amount in at 18, 19,000. But I like it now at 3,000. So it was kind of, as you say, you pay your tuition, but your outlook for 2025, outlook for 2030, what happens beyond 2035? How do you see this whole space changing? I know it's a very
so my view for 2025, I'm generally positive. So I think it's going to be a good year for Bitcoin. I'm certainly encouraged by the way gold is performing. I think that's sending an interesting signal. Gold just blasting through all-time highs. That's no joke. And just to give people a bit of context here, in the last 12, 18 months, gold's added $6 to $7 trillion to its market cap. 6 to 7 trillion. If Bitcoin's market cap was just the amount, exactly, just the amount that gold has gone up, that's a $350,000 Bitcoin. So these things can move very quickly. Now, in 2025, my general view, and I can't see beyond tomorrow, but my general view is that I think it's going to take some work to get through 150, right? So that's my at the moment, as far as I can see ahead, that's probably going to cap us for the time being. I think 2025 is going to be a choppy and difficult year. The world is adjusting to a lot of new stuff, and that change is going to create all sorts of volatility. So I'm measured in the way that things start to move. I think gold is, there's a comment here that gold is leading indicator. I think that's probably true. So I do believe that we're in that environment, but I do not believe that it's going to be quantitative easing and free money and, every altcoin moves up. I just don't think that's going to happen. I'm very, very measured about this stuff. I'm very confident in Bitcoin. I'm very confident in gold. When I look, in fact, just here's your take. If you want to see what's going on with assets that aren't the winners, assets that aren't the best, look at the gold-silver ratio. Look at the Bitcoin dominance chart. They're the same thing, by the way. They are showing you that assets that are not number one ain't doing so well, right? Silver's now 90. So gold-silver ratio is now 90. Bitcoin dominance is now over 60. And that's including 5% of stable coins. There's just a lot of things that are saying that a rising tide may not lift all boats. So I think there's almost like a safety factor in just finding the assets that make sense. Now, long term, the very, very long term, what's my price prediction for Bitcoin? 10.8 kilograms of gold, because that is price parity when those market caps come together. And if you've ever gone and bought physical gold, you know that Bitcoin absolutely destroys it, right?
Yes.
The size of $1,000 of silver coins versus the tiny minuscule amount of gold you need, and then Bitcoin, you can have $1 billion in the same space, just exponentially better.
So I've got to ask you, 10.8 kilograms of gold. What is that price target? Is that $1 million?
I think it's over $1 million now. I think, given gold's movement. It's been a while since I calculated it. Last time I checked it, which was probably 12 months ago, it was like 750K. So I would say it's probably upwards of 25% of that.
And that's a pretty common thing. So far, I think what we've concluded in this first episode, Bitcoin is scarce. The ETFs do not change anything. They've always existed in one form or another. They also do not impact on-chain data. Volatility will fall over time. It takes a lot more cheddar to move Bitcoin as it's a much bigger asset. But with that too, because it's a bigger asset, it's attracting more institutional money. Bigger money is coming
Bigger
in.
it gets, the more money can come in.
And retail are not in control.
Correct.
That's pretty clear. And the top, your ballpark top is 150-ish K. My target was 129. People call me the super bear. You're now the super bull.
120 is the bottom of that topping cloud. So that's the zone where people are expected to start selling. So that zone, again, no one knows, 120 to 150, that's going to be a hard zone to get through, I think.
Exactly. This has been really fantastic. We kept it to an hour. We're going a little bit over, and I know you have another meeting to go to. I do want to share this with everybody so they know. Whoops, wrong chart. Hang on a second. So they know where to find you. I've been subscribed to your Substack since you launched it. I was probably one of the first subscribers. You're on Facebook, you're on LinkedIn, you're on YouTube. You've got a website called checkonchain.com. You're on Twitter. Follow him on Twitter too. There's a lot of good fun stuff there. And your newsletters are fantastic. I want to thank you for your great work and this great conversation as well. People loved it. Loved it.
Thank you, mate. It's been a pleasure coming on. But you know, I mean, we've got a charting website that's got every Bitcoin chart you could possibly imagine. So, and what we try to do, I mean, all the data is available for free, so you can see it all. The way I like to frame it up is I don't want people to have to come to my chart and go, I don't know what this thing does. We're working on putting descriptions and all that there, but basically the chart, if it's doing the thing that I think is important, it will light up and tell you it's doing the thing that's important. So I'm like, let's just bake the insight into the chart, which a lot of places seem to not do.
Beautiful. Love that. And we have a lot more to get to. So thank you so much for my first ever guest on OCTA. I used to call OCTA TA Tuesdays. And then, in 2021, I discovered the importance of OnChain and it became OCTA. So that's what OCTA is for.
There you go. Good stuff, Matt. It was a pleasure.
I really do appreciate the time. Thank you to the audience. Thank you to moderators. Don't forget, I'll pop this up again. Follow James Checkmatey everywhere. And check out his Substack. It's world class. Thank you so much again. Have a great rest of the day. By the way, you're in the other side of the hemisphere, and I think it's Wednesday. So have a good Wednesday.
It is. Yes. Thank you very much.
All right. Cheers, boss. Thank you, everybody.
Cheers.
Good night. Bye.